I wouldn't say the house view is still pretty much the same. What we've seen in the US is we've seen continued strong results from the underlying businesses that we own. So that gives us confidence that that US recovery is moving along as we'd expect.
Yeah.
So that's a positive on the US side. But obviously the market again is at its highs. So what you're waiting for is some recognition or the market to start looking at risk again. And I think that's the part that they've kind of forgotten about. And if you look probably back in the last couple of weeks, you had the positive data which corresponded with weak markets. So to us, that's action that we want to see, because what it's starting to highlight is people are really starting to think about the potential for rates to rise, and the government no longer needing to support that kind of the underlying market. Because what we're seeing from corporates is that things continue to improve, and if anything, they've probably held rates low for too long. So nothing changes in terms of we'd expect rates to start to rise at some point. We don't know when, but the corporates are telling us that the environment's pretty good. I think it is going to have an impact, because the issue that you have is with rates so low, you've had so much support in terms of valuation. Going forward, as rates start to rise, low rates no longer supports your valuation. So if you look at valuations across a lot of markets, valuations that are they're pricing in a lot. So what that says to us is you've got to really be, you've got to do your due diligence and find something that's going to grow, because you're not going to get multiple re-rating anymore, because that's been part of the story over the last 4 or 5 years, is the ability for growth to start to come back, but also multiples to re-rate. Where we sit today is you've probably seen the re-rating story. I don't know when. We don't know when rates are going to start to rise, but as I said, what you're starting to see is positive results on the ground, good data. Yes, you don't get every data point is not a good data point, but the trend is definitely improving data. So the reliance on the Fed to continue to support the economy, that kind of starts to diminish over time. And the big one that's going to play out with rates is obviously going to be the Aussie dollar, because fundamentally what we continue to see is the fundamentals of the Aussie economy continue to decline, but the Aussie dollar has been pretty resilient. So for us, the thing that's kind of holding it there is central bank intervention globally. Over 50% of the world's economy is on zero rates. So as that starts to normalise, that interest rate differential with Australia, I think people start to look at the fundamental story of the underlying Aussie economy and how that relates back to what's happening up in China.